What's up, guys? Welcome back to the ELI5 podcast. My name's Kyle, and today we're going to be talking about the difference between rates. And when I say difference, I mean difference between TradFi and DeFi, aka traditional finance and decentralized finance rates. The reason being is because I've recently gotten a lot of questions, and also rightfully so concerns, about why and how the AmpPay savings rate is so high. So just to dive right into it, AmpPay is a mobile app. It is a self-custodial wallet, meaning you maintain control over your assets. So instead of using a bank and giving your money to a bank, you custody your assets through the AmpPay app. You can export these private keys and take the wallet to any other UI that you want and do any transactions that you want. You aren't giving your assets to another party. So that's kind of where blockchains and DeFi kind of come into play here. You're self-custodying your own assets. So now to dive into the rates. So right now, AmpPay is paying roughly 9.04% APY. Actually, it just dropped 8.97. Sorry about that. Just updated this dashboard here. So right now, we leverage DeFi Carrot. And DeFi Carrot is a protocol built on top of the Solana blockchain that you can deposit stable coins, which are pegged one-to-one to the US dollar. You can deposit stable coins into this protocol, and it will automatically rebalance those assets across lending and borrowing protocols that are built on the blockchain using code, right? So again, you're not giving your money to an entity like a bank, like a Wells Fargo, a JP Morgan, a Citi. You're not giving your money to another entity. You're depositing it into these programs or code on a blockchain so that other people can come and borrow those assets that you're lending. So the rate is based on supply and demand. The more supply there is and the less demand, you'll have lower rates. Lower rates. And then as there's more demand to borrow those assets, or if there's just less supply, then the interest rate goes up. And the reason that that interest rate constantly changes is so that if there is a ton of demand and not enough supply, the interest rate will slowly climb, trying to drive more supply or demand on the supply side for people to deposit their funds to get that high APY. And that obviously will start to bring it back down. So it tries to find an equilibrium. So the TLDR is that this rate is constantly changing. It constantly changes based on supply and demand. On the other side, you have TradFi rates. TradFi rates typically are pretty much all derived from policy. And when I say policy, it's from the Federal Reserve. So the FOMC, or Federal Open Market Committee meetings, I believe there's 8 per year. You can go to the Federal Reserve website. You can see all of the meeting dates. There's one next week, I think Tuesday, Wednesday of September. What date is that? 12, 13, 14, 15, 16, 17th, I think, of September. And so they will have rate policy. So they have a target Fed funds rate. So this is the overnight lending rate between banks, for example. So right now that target rate, I believe, is 4.25 to 4.5%. So then what banks do when they, give out loans to people or pay out savings accounts, those rates and APYs are based on that Fed funds rate. So as that rate goes up, mortgages, car loans, personal loans, whatever it is, will trend higher, because what happens is you kind of take that baseline Fed rate that's set by their, policy. They look at employment, inflation, all those numbers, and they determine if they want to raise rates, lower rates, keep rates unchanged, all that stuff. And so right now, the high end of that target range, 4.5%, mortgages on average are about 6.5%. So banks will take that target policy derived rate, add 200 basis points or 2% because of, potential risk and profit and all that stuff. And that's how you derive the current 30-year mortgage. Now, there's obviously a lot more nuance that goes into these things, but that's just a very high level. That policy, that rate set by the Fed, then derives 30-year mortgages. You might have auto loans that might be a little bit higher than that. Personal loans might be a little bit higher than that. Obviously, it depends on user credit scores and where the house is and all that stuff. But you kind of get the gist, right? So TradFi, savings account, those rates are all based on a policy-derived rate. And that policy-derived rate is set by the Federal Reserve. And then in DeFi, you have this supply and demand. So it's a completely different baseline of how this rate is how this rate comes about. And that's why you can see things like 8.97% as the last 30-day average APY. You can see the last 1 day is 6.67%, 7 days 9%, 14. Yeah. So you can see all of that on Carrot's website. Now, to compare AmpPay with a traditional bank, that's where the rates are coming from. But when you look at a savings account right now, not only do you have these insanely low rates at a lot of banks, 0.01% interest at Wells Fargo, Citigroup. I think they have something similar, but if you go to banking and then savings, you can see right here, they have an intro rate for 3 months, 4.25% if you deposit $25,000 or more. And then they actually do pay out a little over 1%. So that's not terrible. But again, there's probably restrictions on how much you can withdraw. There's a lot of times minimums or fees if you don't maintain a certain minimum, and only a certain amount of withdrawals that you can make per month. Otherwise, there's penalties and stuff like that. Bank of America, similar to Wells Fargo, 0.01%, a little bit of a boost with, some tiers. Now, you do have online-only savings accounts, meaning you can't go into a brick and mortar store and withdraw your money. So this is something like Ally. They're paying 3.5%. Again, you can see the Fed fund overnight target rate, 4.5%, and then the bank will pay you at 3.5%. So they're saving money on overhead costs. They don't have brick and mortar. They don't have as many employees. So basically, they're subtracting 1% from that Fed funds target rate, from that policy set rate, in order to pay this out. So they're still able to make that profit margin between Fed funds overnight lending rates, and then obviously you have mortgages and auto loans and personal loans that are probably above that Fed funds target rate. And then same thing with Goldman Sachs. They have this Marcus online-only savings account, 3.65%, a little bit higher than Ally. But again, you can see right here, same-day transfers of $100,000 or less, you can potentially get your money out within the same day. However, business days. So, for example, if you were to try to get your money out on a Friday and you did it too late in the afternoon, you might have to wait 3, if not 4 days, if Monday's a holiday, to actually get those funds. The difference is with an app like AmpPay on your phone, you can, have an AmpPay Black Card. You could literally withdraw from the savings option in the app, immediately top up your card, and then tap to pay anywhere Visa's accepted, anywhere in the world. So you have full control of your own assets. There's no restrictions on when you can deposit, when you can withdraw, how much. There's no minimums. And obviously right now and over the last 6 months, the rates have kind of been anywhere from 6 to 12.5% or so. So literally just over the last 6 months, you've earned more in interest than you would from obviously Wells Fargo, Citi, and Bank of America, but you've also earned more than if you had your money in an Ally account for a full year. So it is based on supply and demand. It constantly changes and goes up and down. It could go to zero tomorrow, right? If there's no demand or there's a ton of supply that comes in, it could drive that rate down. But worst case is you might then see demand pick up the next week or the next day on the borrow side, and then you see the rate go back up. So obviously you can constantly monitor it. Every time you open the app, that rate is refreshed to sort of show you the current 30-day average. But yeah, we think that this is a much better option for users. It's much more instant, much more on demand. It's flexible, and overall, it's been a lot higher than traditional finance savings accounts. So be sure to check out AmpPay, available in the Solana App Store, Google Play Store, and Apple App Store. You can just download the app. It's free to download. There's no cost to open up a savings account. There's no minimum amount. The cards are free as long as you're in an approved area, and we'll have virtual accounts coming out soon, so you can easily connect your traditional finance bank account and send money directly into your AmpPay wallet to take advantage of sort of the high yield savings. Also, when the virtual accounts are ready, you can actually direct deposit directly into your AmpPay wallet. So some very cool things that we're releasing soon. There will also be a portfolio option to swap for other things like Sol, Bitcoin, meme coins if you're into that, and X stocks, which are tokenized stocks, but on the Solana blockchain. So you can still get exposure to things like Tesla via this tokenized version of it that sort of tracks the actual stock price. So some cool things in the pipeline, but hope this helped explain why the rates are so different, how the rate can be, close to 9% or over 9% at sometimes in AmpPay, when at Wells Fargo it's 0.01%. So hope this was eye-opening. Hope it was helpful. If it was, please give this video a thumbs up, share it, subscribe to the channel, whether you see this on X, give me a follow, or on Spotify or YouTube. But until next time, guys, thanks for watching.